Financial management is concerned with planning, directing, monitoring, organizing, and controlling monetary resources of an organization. Financial management simply deals with management of money matters. Management of funds is a critical aspect of financial management. The process of financial management takes place at the individual as well as organization levels. Our area of dealing is from the viewpoint of organization. Financial management is a combination of two words, finance and management. Finance is the lifeblood of any business enterprise. No business activity can be managed without finance. It has been rightly said that business needs money to make more money. However, money begets money when it is properly managed. Efficient management of business is closely linked with efficient management of its finances. Financial management is that specialized function of general management which is related to the procurement of finance and its effective utilization for the achievement of common goal of the organization. The general meaning of finance refers to the provision of funds as and when needed. However, as management function, the term financial management has a distinct meaning. Financial management deals with the study of procuring funds and its effective and judicious utilization in terms of overall objectives of the firm and expectations of the providers of funds. Financial management refers to that part of management activity which is concerned with the planning and controlling of firm's financial resources. Financial management is a part of overall management. All business decisions involve finance. Where finance is needed, role of finance manager is inevitable. Financial management deals with the raising of funds from various sources dependent on the availability and existing capital structure of the organization. The sources must be suitable and economical to the organization. Emphasis of financial management is more on its efficient utilization rather than raising of funds alone. The scope and complexity of financial management has been widening with the growth of business in different diverse directions. As business competition increases with a greater pace, more support for financial management is needed in a more innovative way to make the business grow ahead of others. The basic objective of financial management is to maximize the value of the firm. The purpose is to achieve maximization of share value to the owners, that is equity shareholders. The objective of every company is to create value for its shareholders. Market price of equity share is the barometer for showing the real value. The basic objective of financial management is to maximize the shareholders' wealth represented by the market value of its equity shares. Financial management is concerned with three activities. Anticipating financial needs, which means estimating the requirements of the firm in terms of long-term and short-term needs or investment in current and fixed assets. Acquiring financial sources from different sources to meet the financial needs. Allocating funds to maximize shareholders' wealth. The term financial management has been defined differently by various authors. Howard and Upton defines financial management as an application of general management principles to the area of financial decision making. In terms of Joseph and Messi, financial management is the operational activity of a business that is responsible for obtaining and effectively utilizing the funds necessary for efficient operations. In the words of James C. Van Horn, financial management is concerned with the acquisition, financing, and management of assets with some overall goal in mind. As per S.C. Kutchal, financial management deals with the procurement of funds and their effective utilization in the business. From these definitions, two basic aspects of financial management emerge: procurement of funds and effective and judicious utilization of funds. Financial management has become so important that it has given birth to financial management as a separate field of study and subject.
After studying this module, we shall be able to comprehend the meaning of financial management, know the nature and scope of financial management, learn about the evolution of financial management, appreciate the interdisciplinary aspects of financial management, and understand the meaning and components of financial system.
The nature and scope of financial management has expanded in its coverage and has seen a large number of new developments and innovations from academicians, researchers, practitioners, and regulators. Traditionally, financial management was a part of economics concerned with record keeping, arranging funds, managing cash, etc., and thus it was episodic in nature. It was viewed from outsiders, that is, suppliers of funds viewpoint, and was focused on long term financing and was more of descriptive in nature rather than analytical. However, later on, with increasing competition, globalization, growth and complexity in business activities, scope of financial management widened. It was no more an episodic activity, but became as regular in business as other areas like productions, marketing, etc. Financial management emerged as a separate discipline. Focus was more not just on long term financing and record keeping, but also on appraisal and comparative evaluation of long term investment proposals, management of funds required for running day to day business operations as well. As sole proprietorship and partnership gave way to corporations as preferred form of business, dividend policy and corporate governance rose in prominence. The nature of financial management in modern times is not more just theoretical or conceptual, but is also empirical based and analytical. Today, almost every business decision and activity involve some financial implications, and so financial management is required to evaluate their financial impact. Since decisions in virtually all areas of management like purchase, production, marketing, operations and logistics, human resource, etc., have financial payoffs involved, they come within the scope and purview of financial management. Also, since financial decisions, especially those relating to procurement and utilization of funds, are necessary and have significant impact in every aspect of life, the scope of financial management covers all decision making entities of society like individuals, households, businesses, organizations, and government.
Nature and scope of financial management has evolved over a period of time. Traditionally, financial management was a part of economics concerned with record keeping, arranging funds, managing cash, etc., and thus was episodic in nature. It was viewed from the outsider's point of view was focused on the long term financing and was more of descriptive in nature rather than analytical. But in modern times, the financial management is regular in nature and has emerged as a separate discipline. Apart from long term financing and record keeping, focus is also on appraisal and comparative evaluation of long term investment proposals and management of funds required for running day to day business operations. Nature of financial management in modern times is no more just a theoretical or conceptual, but it is empirical based and analytical.
The traditional approach was evolved during the 1920s and 1930s period and continued till 1950. The approach had been discarded due to the following limitations: no involvement in application of funds. The finance manager had not been involved in decision making of the allocation of funds. He had been ignored in internal decision making process and treated as an outsider. Second, no involvement in day-to-day management. The focus was on providing long-term funds from a combination of resources. This process was more of one-time happening. The finance manager was not involved in a day-to-day administration of working capital management. Smooth functioning of the firm depends on working capital management, where the finance manager was not involved and allowed to play any role. Third, not associated with decision making allocation of funds. The issue of allocation of funds was kept outside the functioning of the finance manager. He had not been involved in decision making for its judicious utilization. Outsider looking in approach. The subject of finance has moved around the suppliers of funds like investors, financial institutions, banks, etc., who are outsiders. The approach has been outsider looking in approach, since finance manager has never been involved in internal decision making process. Raising finance was an infrequent event. Its natural implication was that the issues involved in working capital management were not in the purview of finance function. In a nutshell, during the traditional phase, the finance manager was called upon in particular when his specialty was required to locate new sources of funds as and when the requirement of funds were felt. Traditional approach has outlived its utility in the changed business situation. The scope of finance function has undergone a sea change with the emergence of different capital instruments.
The evolution of financial management may be divided broadly in three phases: traditional, transitional, and modern phase. The traditional phase lasted for about 4 decades till early 1940s. In this phase, the focus of financial management was mostly on the events of the episodic nature and was mainly descriptive. Financial management was viewed mainly from the viewpoint of investment bankers, lenders, and other outsiders. Next was the transitional phase. It began around the early 1940s and continued till early 1950s. Financial management had almost similar nature and scope during this phase as during the traditional phase. However, there was an increasing emphasis on planning, procuring, managing, and controlling funds to meet day to day financial needs of the business. Financial issues began to be analyzed in an analytical framework. Then came the modern phase. The mid 1950s marked the beginning of modern phase in the financial management owing to increasing competition, growth opportunities, globalization, breakthroughs in the economic theory, and development of quantitative methods of analysis. This led to the development of a more analytical, empirical approach to decision making. Management, or insider's viewpoint, became central to the financial management. Development of theory of portfolio management by Harry Markowitz in 1950, theory of leverage and valuation of firm by Modigliani and Miller in 1958, and option valuation method by Black and Scholes in 1970s are regarded as the milestones in the evolutionary journey of the modern financial management.
Since then, the fields of capital budgeting, capital structure, efficient market hypothesis, option pricing theory, agency theory, financial derivatives and risk management, valuation model, dividend policy, working capital management, financial modeling, financial engineering, international finance, and behavioral finance, to name a few, have been fascinating developments. With the ongoing endeavors of various academicians, researchers, practitioners, and regulators, we are poised to see many more significant advancements in these and upcoming areas, which would add further dimensions to financial management.
Let us now move on to the interdisciplinary aspects of the financial management. Let us begin with the economics. Economic theories have provided guidelines to the finance manager for decision making in real business situations like budgeting, evaluating alternative investment proposals. Finance manager must have a clear understanding of microeconomic and macroeconomic concepts. These are of great relevance to the finance manager in budgeting and forecasting, evaluating alternative investment proposals, profit planning, and for making other vital decisions.
There are two areas of economics with which the financial manager must be familiar: microeconomics and macroeconomics. Microeconomics deal with the economic decisions of individuals, households, and firms, whereas macroeconomics looks at the economy as a whole. The typical firm is heavily influenced by the overall performance of the economy and is dependent upon the money and capital markets for investment funds. Thus, financial managers should recognize and understand how monetary policies affect the cost of funds and availability of credit. Financial managers should also be versed in fiscal policy and how it affects the economy. What the economy can be expected to do in the future is a crucial factor in generating sales forecasts as well as other types of forecasts. The financial manager uses microeconomics when developing decision models that are likely to lead to the most efficient and successful modes of operation within the firm. Specifically, financial managers use the microeconomic concept of setting marginal cost equal to marginal revenue when making long term investment decisions, capital budgeting, and when managing cash, inventories, and account receivables, that is, working capital management. Thus, a knowledge of economics is necessary for a financial manager to understand both the financial environment and the decision theories which underlie contemporary financial management. He should be familiar with these two areas of economics. Macroeconomics provides the financial manager with an insight into policies by which economic activity is controlled. Operating within that institutional framework, the financial manager draws on microeconomic theories of the operation of firms and profit maximization. A basic knowledge of economics is therefore necessary to understand both the environment and the decision technique of financial management.
Accounting. Financial managers make extensive use of historical accounting information for analyzing past performances and forecasting. So, as one of the important users of accounting information, they should be capable of understanding and interpreting financial information. Cost and management accounting are specialized branches of accounting which provide accounting information that facilitates efficient decision making.
Financial managers play the game of managing a firm's financial and real assets and securing the funding needed to support these assets. Accountants are the game's scorekeepers. Financial managers often turn to accounting data to assist them in making decisions. Generally, a company's accountants are responsible for developing financial reports and measures that assist its managers in assessing the past performance and future direction of the firm and in meeting certain legal obligations such as the payment of taxes. The accountant's role includes the entrepreneurial issues. Accounting function is a necessary input into the finance function. That is, accounting is a sub-function of finance. Accounting generates information or data relating to operations or activities of the firm. The end product of accounting constitutes financial statements such as balance sheet, the income statement of profit and loss account, and the statement of changes in financial position or cash flow statement. The information contained in these statements and reports assist financial manager in assessing the past performance and future directions of the firm and in meeting legal obligations such as payment of taxes and so on. Thus, accounting and finance are functionally closely related. Moreover, the finance or the treasurer and accounting, the controller, activities are typically within the control of the vice president, director finance, or CFO of the company. These functions are closely related and generally overlap. Indeed, financial management and accounting are often not easily distinguishable. In small firms, the controller often carries out the finance function, and in large firms, many accountants are intimately involved in various finance activities.
Next is statistics. In the modern times, financial management has become more analytical and empirical and thus requires application of statistical tools and techniques on the raw data to derive meaningful interpretation and conclusions. Statistics tools and techniques such as measures of central tendency, measures of dispersion, correlation and regression, sampling and estimation, hypothesis testing are widely applied across all decision areas of financial management such as capital budgeting, capital structure, dividend, and working capital. Let's see how financial management is related with the top management. Top management formulates and implements strategy to maximize wealth of shareholders and achieve the stated goals and objectives of the business. All strategic decisions like strategic alliances, joint venture, merger and acquisitions, demerger have significant financial impact on profitability, liquidity, and solvency of the firm in the long run. So, top management, along with the chief finance officer, assesses the impact of the financial decisions, incorporates them in the strategy formulation.
We depict the relationship between financial management and its primary supportive disciplines marketing, production, quantitative methods, and human resource management are directly related to the key day to day decisions made by financial manager. For example, financial managers should consider the impact of new product development and promotion plans made in the marketing area because these plans will require capital outlays and have an impact on firms' projected cash flows. Similarly, changes in the production process may necessitate capital expenditures which the firm financial managers must evaluate and then finance. The tools of analysis developed in the quantitative methods area are frequently helpful in analyzing complex financial management problems. Compensation policies may impact the extent of agency problems in a firm.
Production and marketing management are related to financial management. Production department incurred expenditures which are sent for approval to finance department. Finance manager, after evaluating estimates, may suggest changes and thereafter allocates the required funds to the production department. Finance managers work with their marketing colleagues to evaluate the profitability of the alternative marketing proposals and after due deliberation approves funding for the selected proposals. Human resource management. Financial manager discusses benefits and cost of human resource department decisions that have financial implications with the human resource manager and approves funds to implement them. Concepts from the fields of psychology and organizational behavior are being today used by the finance manager to understand the behavior of investors. This new area, called behavioral finance, has grown rapidly in the past few decades by attracting interest of the academicians, researchers, finance managers, and practitioners alike. We shall now discuss the meaning and the components of financial system. Financial system is the system that channelizes funds from the fund surplus units or savers like households to funds deficit units like governments and business organizations. Financial systems consist of closely interrelated financial markets, financial assets or instruments, and financial institutions or intermediaries functioning within a regulatory framework. All decisions of the financial management and entire functioning of the finance department of any organization is directly affected by and linked to the surrounding financial system or environment. Financial markets. A financial market is a market in which financial assets are traded. Financial markets facilitates raising of capital, transfer of risk, price discovery of the financial assets, global transactions with integration of financial markets, transfer of liquidity and international trade. There are two types of financial markets. The first one is capital market. Capital markets are the markets for the long-term financial assets like shares, bonds. Capital markets can be further divided into primary and secondary market. Newly formed issued securities are bought or sold in the primary markets. Secondary market allows investors to buy and sell existing securities. The second type of market is money market. Money market is the market for short-term debt financing and investment. Foreign exchange markets facilitate the trading of foreign currencies.
A financial market is a market in which financial assets like shares, bonds are traded. Financial markets facilitate the raising of capital in capital market, the transfer of risk in the derivatives market, price discovery of financial assets, global transactions with integration of financial markets, the transfer of liquidity in the capital market, and international trade in the currency markets.
Financial assets or instruments represent a financial claim of the holder or purchaser of the asset over the issuer or seller. Currencies, bank deposits, post office savings, shares, bonds, debentures, derivatives, mutual fund units are some commonly used financial assets. Financial institutions or intermediaries. Financial intermediaries are the institutions which connect or establish linkages between fund surplus and fund deficit units, allowing transfer of the funds from the savers to the borrowers. commercial banks, insurance companies, mutual funds, non-banking financial companies, investor bankers, merchant bankers, brokerage houses, central or state government established financial institutions are major financial intermediaries. Financial system in India is regulated by the framework of eminent statutory and government bodies along with some acts. Financial system in India is monitored and controlled by several regulators and regulations. Main regulators are Reserve Bank of India (RBI), Security Exchange Board of India (SEBI), Insurance Regulatory and Development Authority (IRDA), Ministry of Finance, Ministry of Corporate Affairs. Major legislations governing and influencing financial system in India are Companies Act 2012, Securities Contract Regulation Act 1956, Banking Regulation Act 1949, Income Tax Act 1961, and Negotiable Instrument Act 1881. Let us now recapitulate what we have learned in this module. In this module, we have learned that the financial management is concerned with the acquisition of the funds and their optimum utilization. Nature and scope of financial management has evolved over time. Financial management is evolutionary concept. Its evolution may be divided broadly into three phases: the traditional, the transitional, and the modern phase. Financial management is related to other disciplines such as economics, accounting, statistics, and other areas of financial management like production, marketing, human resource, and top management. Financial management and systems consist of closely interrelated financial assets or instruments, financial markets, and financial institutions or intermediaries functioning within a regulatory framework.
Financial management is concerned with the acquisition of funds and their optimum utilization. Seeks to acquire funds at minimum cost and generate optimum return by its efficient utilization commensurate with the desired level of risk. The nature and scope of financial management has evolved over a period of time. It has expanded in its coverage and has seen a large number of new developments and innovations from academicians, researchers, practitioners, and regulators. Financial management is an evolutionary concept. Its evolution can be divided broadly in three phases: the traditional phase, the transitional phase, and the modern phase. Financial management is related to other disciplines such as economics, accounting, statistics, human resource management, psychology, etc., as well as other areas of management like production management, marketing management, and human resource management. Financial system is a system that channelizes funds from fund surplus units, that is the savers, to funds deficit unit like governments and business organizations. Financial systems consist of closely interrelated financial assets or instruments, and hence financial markets and institutions or intermediaries functioning within the regulatory framework.